Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss rising interest rates and what they mean for investors. Specifically, we'll focus on what are known as real yields and why they matter for your portfolio. Interest rates have been a major topic for investors, and for good reason. Treasury yields have climbed to some of their highest levels in years, driven by a mix of concerns around inflation, energy prices, the national debt, and Federal Reserve policy. Over the next few minutes, we'll break down what these moves mean, how they affect different parts of the market, and why a well-balanced portfolio matters more than ever in this environment. First, let's talk about real yields and why they are so important. You may be familiar with the concept of a nominal yield on a bond, which is simply the stated interest rate. When you adjust yields for inflation, they are known as real yields. They show what an investor actually earns in purchasing power terms. This makes real yields one of the most important ideas in all of investing. As this chart shows, real yields have changed dramatically over the past decade and a half. Back in 2020, real yields actually turned negative, meaning investors were accepting a guaranteed loss of purchasing power just to hold the safety of U.S. Treasury securities. This was in large part by design. The Fed did this to push investors toward stocks, real estate, and other higher yielding assets. Today, the picture looks very different. The 10-year yield now stands at around 2.4%, a level well above anything we've seen since the global financial crisis. Next, rising yields don't just affect bond investors, they affect how attractive different asset classes are relative to bonds, including the stock market. One useful way to compare stocks and bonds is through what is called the earnings yield, which is the earnings generated by the S&P 500 divided by its price. In simple terms, the earnings yield and a related measure called the equity risk premium help us to compare stocks to bonds. For much of the time period after 2008, real bond yields were near zero or even negative. In that environment, stocks had very little competition. Investors were willing to accept lower returns from stocks because there simply weren't many alternatives. That has changed. With real yields now at 2.4%, government bonds offer a genuinely attractive inflation-adjusted return for the first time in years. This means the balance between stocks and bonds in a portfolio deserves more careful attention than it did a decade ago. Finally, there is another important factor keeping yields elevated, and that is uncertainty around Federal Reserve policy. As this chart shows, the Fed's balance sheet has grown significantly with each economic crisis over the years. While it has been shrinking gradually in recent years, it remains far larger than it was before 2008. The new Fed chair, Kevin Warsh, has expressed a strong preference for reducing the balance sheet when the economy is healthy. Selling Treasury securities and mortgage-backed securities puts upward pressure on interest rates and raises borrowing costs across the economy. This means that portfolios need to reflect the current rate environment and not past periods. Holding a well-constructed balance of stocks, bonds, and other assets aligned with your specific financial goals is more important than ever. We hope you found these insights on real yields and interest rates helpful. If you would like to discuss how the current rate environment affects your portfolio or financial plan, please don't hesitate to reach out. We look forward to speaking with you.